Hello, everybody. We're just going to wait a minute here for more people to join us before we get started. But if you came to the Zoe webinar, you are in the right place. Let me stop sharing screens here for a second. Oh, nice. Tons of people joining, so I'll give it another minute. All right. Well, for the sake of people that showed up on time, maybe we go ahead and get started. Let me put myself on mute here.
Absolutely. Welcome, everybody. Thank you so much for joining us. So if you could go ahead and share your screen again, do a quick welcome. Thank you. A brief disclosure from Zoe Financial. This presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. Today's webinar is on Equity Compensation 101. We're going to be talking about how to manage your slice of the pie. Today's webinar is, of course, hosted by our CEO and founder, Andres Garcia Maya. A brief intro. Prior to Zoe Financial, Andres was an executive director at JP Morgan Asset Management, where he helped oversee over $300 billion in assets. He is a CFA charter holder and obtained an MBA from the Wharton School at the University of Pennsylvania, where he received both the Joseph Wharton Fellowship for Outstanding Record of Academic Achievement and the Toigo Foundation Fellowship. With you, Andres.
Thank you so much, Alexandra, for that. And none of these webinars would be possible without Alexandra, Camila, and the marketing team. So thanks so much for putting all the material together and kind of making it all happen. So thanks everyone for joining. Let me go ahead and introduce the speaker for today. So I'll just basically kind of guide the conversation, but the real star of the presentation is Christy Matson, right? So she's a CFP, a certified financial planner. She's a director here of financial planning at Zoe Financial. Christy graduated from Texas Tech University with a degree in personal financial planning. So she literally knew she wanted to do this even in college, which is pretty insane. In 2015, she joined Goldman Sachs ICO. Can you still hear me, guys? Or did I lose you? Yeah, okay. Yeah. In 2015, she joined Goldman Sachs ICO Personal Financial Planning Division as a financial planner and gained exposure to the executive clientele. She literally had billionaires as clients at Goldman Sachs. So she got some great experience when it comes to this type of specific topic at the highest level. She grew in her role to vice president and took over training and development for financial planners at Goldman Sachs. After 6 years with Goldman, she joined Zoe as the director of financial planning this year. And this part, I don't think Christy knows this, but we literally got over 2,000 resumes for this role. We interviewed hundreds for over 18 months before we interviewed Christy. And the moment that the team interviewed Christy, we all walked out. We're like, this is it. This is the person that not only is going to drive kind of the financial planning process here within Zoe, but Christy actually runs our due diligence process of all the advisors in the network. So we're really excited to have you kind of run this webinar, Christy, but also for you to be part of the Zoe team.
Thank you so much. I didn't know that. I'm excited to be a part of the team, though. It's been amazing so far.
Awesome. All right. So before we, and I think I switched from, as long as you can hear me okay, Christy, when I take off the headphones?
Yeah, you're good.
Okay. So I'll start for the number of people that might be joining us for the first time, just to hear a little bit about what Zoe's all about, right? So our mission is to empower Americans to make better financial decisions. And when it comes to specifically what we're talking about today is essentially perfect for this mission, right? So how do we help people with topics like this that are complex, but are really important for you to get right? And we could talk a little bit more about, what we do as a marketplace, but most important of all is just empower people with the right information so they can make better financial decisions. So that's our mission. For this webinar, we'll discuss common types of equity compensation, how to navigate taxes when it comes to this topic, how the equity comp ties to the plan. And what I mean the plan is your holistic financial plan, right, to your whole financial life. How do you know your advisor knows about this, right? So in essence, what are some red flags or questions to ask of your advisor if you have one, or if you're in the market for one, to ensure that they could help you with this topic? And then lastly, but not least, we'll turn it over to Q&A. And I saw a couple of people already ask the question of, is this going to be recorded? It is going to be recorded. So you could, after this presentation, feel free to pass it on to friends, family that might find the topic interesting. Okay, so just to get us started, Christy, why don't you kind of walk us through some of the different options out there, or call it the different ways in which people could get paid when it comes to equity compensation?
Absolutely. So there are so many different types of equity compensation. The list goes on and on. As you can see from this slide, there's so many different types because it's gotten really popular over the last several years. Companies are really integrating this into their compensation plans, trying to attract and retain the right employees. And based on different changes with what the companies are trying to do, but with tax laws, things are just iterating and changing, and new types of equity compensation are coming to the market. So there are a lot of different ones on the screen. We definitely don't have time to touch on all of them, but want to make sure to address that, we're going to try to hit the high points of everything.
Yeah. And maybe what we could do is just kind of focus on two that are the most common, but we wanted to put this up in the screen just so that people know, look, there are others. And if the ones that we discussed today are not the ones that are kind of in the screen that you're like, oh, I think I have those, feel free to shoot us an email. We'll have all the information of like how you could reach us, and we can make sure to kind of provide the right content around the topic if we don't hit on it. But for today, maybe Chris, if you can walk us through the most common type of equity compensations that you've seen in the many interactions you've had with different types of clients in the past.
Certainly. So the most common equity compensation that I see are stock options. So within that realm, there's still different types of stock options. So that's probably the most common one on the market. The second most common is restricted stock. So we'll kind of dive deeper into these two buckets. But when I think about restricted stock, there's multiple types there. So restricted stock units, performance stock units are very similar, but have a performance component attached to it, as opposed to stock options, which are work and function a little bit different. There's non-qualified, and then there's incentive, which are the qualified version of stock options. So those are the two buckets that I see compensation in the equity world that are the most popular. We'll try to make it not as complicated as you think it could be, and hopefully provide some color onto those two sections.
Got it. And then on this page, I think we throw it in here to try to simplify how to think about these two different buckets, right?
It's so confusing when you have equity compensation. So let's say if you have some equity compensation, you may not know what kind it is, because people use these terms interchangeably. They think they all mean the same thing, even when they don't. So this is the easiest way, in my opinion, to decipher what you actually have. So if equity compensation is part of your employment package, if there is a strike price given to you, as when you started, you would know there's a strike price associated with it, that means you have a stock option. So that's the bucket of equity comp that you're in. If your equity compensation does not have a strike price, so you just have the number of shares and a vesting schedule, then that means it's restricted stock. That's the easiest way to decipher which one you actually own. So then you know, okay, here's how it actually functions.
Yeah, that's a great way to to put it, because I think there's so much kind of acronyms that people throw around. But if you guys, people are listening in, these are the two things you could remember as we go through this, right? Strike price, it's an option. No strike price, it's stock.
Yeah, so let's start with restricted stock. I think it's a little bit more straightforward. So we'll walk through kind of what it actually is and why you should be excited if you have this. It's a huge part of compensation for some employees and some companies. So let's just go through an example, and maybe this identifies with your situation. So if you start a new job, you get the offer letter, it has the salary, maybe a bonus, and it also says you get 1,000 restricted stock units. What does that mean? So the day you start, let's say the company, they value their stock at $10 a share. Now, if it's a public company, it's really easy to figure out what that value is. If it's not, if it's a private company, then ask the question. You need to know this information, especially if you're in the job market or you've accepted a position. You need to know that because you need to know how much those shares are worth. So if you have the number of shares and you have the value that the shares are priced at, simple multiplication gives you the value of that equity compensation piece. The most key feature of restricted stock, again, in my opinion, is the vesting. This is what to get excited about. And a very common way to phrase a vesting schedule, you may see this in your offer letter, it says, your vesting schedule is annually over 4 years with a 1-year cliff. That may just sound like gibberish. 1-year cliff, what is this cliff? So to put it a little simpler, what that means is a cliff, if it's 1 year, nothing happens for 1 year. So it's basically nothing, 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 and then it drops off and excitement begins. That's when things start to roll with the equity portion. So in this scenario, you've got a 4-year vesting. It starts 1 year from the day that you started at your job. So after that first year, 1/4 of your shares vest. If I got 1,000 shares, 1/4 of that, 250 shares, that's what vests on my 1-year work anniversary. And then it snowballs for the next 3 years. Once you have all of the years vested, it's done. You've got all the equity out of that award, and then there's nothing else left. Some companies may do additional grants, so you'll have kind of a snowball effect of equity awards, or you may get it at the beginning and that's all that the award is. So when it vests, this is the exciting part because this is what you actually get paid. Let's say the stock is worth $20 after you've worked at this company for a year. So it's doubled in 1 year. This happens a lot in the startup industry. It's exciting. You want to see the value of your company grow. So now that 250 shares that just vested times the fair market value of the vesting is $5,000. So you've only got 25% of your shares, but it's already worth 50% of the original price. So this is how people get excited about equity compensation because the values can be pretty substantial. So that $5,000 doesn't necessarily mean you get a check for $5,000 if you get stock deposited into your account for $5,000, if only. But what happens is taxes are then taken out. So taxes, disclaimer, is going to be a little bit different for everybody. But here's the general structure of how it works. For restricted stock, there's not a lot of tax decisions you have to make. You get the award, it vests, taxes are taken out. You didn't make any decisions. That's just how the company structured the plan. So it's pretty straightforward in that you're just kind of going along, waiting the time period. So restricted stock is treated kind of like a bonus. So if you're familiar with getting a cash bonus, maybe an end of the year bonus, taxes get taken out of your paycheck and the net amount is deposited in your checking account. For restricted stock, it's the same way. Taxes get taken out of those shares and the net shares is deposited in your brokerage account. So think of it very similar. So you're paying federal taxes. So in this example, your $5,000 of income, you're having 22% withheld for federal taxes. an additional 5% for state taxes. Depending on your state, that could be higher or lower. Then you also have FICA taxes because it's going through payroll. So that's Social Security, Medicare tax, that's being taken out. And then the net amount, so in this scenario, $3,000 is coming in the form of stock into your brokerage account. So again, you haven't had to make any decisions right now. It's just happened because you waited the appropriate amount of time. So that's kind of a basic scenario of restricted stock. Now let's see how that differs from stock options. So like I said before, stock options are the most common type of equity compensation, and trending is still going to be the most common type. They have a few more complexities involved because you actually have some decision points that you need to make beyond just the vesting. You have to decide when to buy and sell. Lots of different factors go into this, which is good and exciting because it gives you some control and ownership over your finances. It's also intimidating because there's a lot of confusing factors that go into this. So when I think about stock options, I really see two main kinds of stock options. So like I said, there could be a lot of different factors and variables that go into this, but the first main kind is non-qualified stock options. So the biggest differentiator of this is it's going to be taxed as ordinary income. And I'll go through an example so that this makes a little more sense and it's not just foreign tax lingo that I'm using. The second type of stock options is incentive stock options. So the things that these two buckets have in common, they both have that grant date. So a grant date, that's a common terminology. That's when you get notified that you got an award. So the day you started your job or the day that you received an extra equity award, that's the grant date. They also have an exercise price, same thing as a strike price. Use those things interchangeably. That's how much you can buy the stock at. So like we said in restricted stock, you're just getting the stock at whatever it's valued at on the day it vests. For stock options, it's a little bit different because you actually have to actively buy the stock, and then you usually get it at a discount to the market rate. So again, we'll go through an example of why you care about this. Other common features in these two areas, they both have a vesting schedule, same as restricted stock. Most equity compensation is going to have some vesting schedule, and it's going to be different for each company that you're with. So there are some typical vesting schedules like the one that we'll go through and the one we just went through with the restricted stock, but it's different for every company. And that's another thing. If you have equity compensation, you don't know your vesting schedule, raise your hand and ask your HR, ask your boss, figure out what that is, because that's really important information for you to know, the same as it is to know what your salary is. That's a big part of your compensation, most likely. Another key feature of stock options is the expiration date. So with restricted stock, like we're comparing, they didn't expire, they just vested and that was it. Stock options, because you have to take action once it's vested, you have a window from the vesting date to the expiration date. You have to make an election and take action. Otherwise, you get nothing. So there is an expiration. Most companies give you 10 years. So it's a pretty long window. But if you're in that startup phase and you're working at a company that's not publicly traded, 10 years goes by really fast. So again, that could be 5 years for some companies. It could be 7 years. Another good piece of information to know when you get stock options granted to you. So just to kind of recap the difference on these two, the biggest thing is when it comes down to the tax. They function pretty similar. There's a few different features that go into it. The tax is the biggest difference. With incentive stock options, there's a few different hurdles you have to go through to make sure that they stay qualified as opposed to non-qualified stock options. They're less common and less popular in the marketplace right now. So we won't kind of get into the weeds too much. I know I'm probably giving you guys a lot of terminology, but let's focus on the non-qualified stock options since that's the most popular type. So key things that you care about if you have stock option equity awards, you want to know how it works, kind of the life cycle of what that looks like for you. So the first thing is when the option is granted. Again, that's when you know, okay, I have it. Then you care about when it vests. And so it may have different vesting schedules, but once it's vested, that's when you can take action. The action you take after it vests is going to be to exercise those options. That means buying stock. Once you own the stock, so you've exercised it, now you have stock in your account. Now what do you get to do? Anything you want, it's yours. You can sell it, you can keep it, you can gift it. So typically, if this is a part of a compensation, people are then looking to diversify and sell some of that stock. And then that is when you get the cash. So if you think about equity compensation as it relates to cash value, you have to go through a lot of steps before you actually get cash that you can spend and use for expenses that way. So that's kind of the life cycle of stock options. So let's kind of dive deeper into the vesting of that so you really understand when you actually can need to be doing something or taking action on these. So for this example, let's say you have a 5-year vesting schedule with a 1-year cliff. So again, 1-year cliff, nothing happens for 1 year. Then it's divided over the remaining years of when it vests. So you can see 5,000 shares vesting over 5 years. Now, when you get stock options, like we mentioned, you have that strike price. That's how you know it's a stock option. Regardless of when it vests, same strike price for all of the shares. So I get the strike price on year 2. It's the same as year 3, 4, and 5. So I can buy the stock at that same price. Now, the goal, if you kind of think big picture stock options, it's to buy stock at a discount. So hopefully over the next 5 years, the price of your company, the fair market value, is going up. If it is, you're getting to buy those shares at a discount and you have this locked in gain where you may be able to sell shares, get some liquidity, get more income than you were expecting if the company performs well. So once it vests, that's when you get to take action of buying stock at that strike price.
Christy, quick question. So there's a 10-year, usually a 10-year period of essentially where you could exercise the option, right? That's what you had mentioned.
Yeah.
Is there a tighter window when you get, like any other windows they should be aware of? Meaning if you get a stock option, you have 10 years to exercise your period, or is there any other kind of shorter time period that people should be aware of? You know, there was a question around like the window of time on the options itself, or is that's usually how it works, is they just get 10 years and that's it?
So if nothing happens with, anything in your life or the company's life, it's 10 years. But most likely things are going to change over the next 10 years. Like you may decide you don't want to stay at that company. So if you leave a job or get terminated from a job, those stock options may have a 30-day window to exercise, or it could be shortened that way.
Yeah, I think that's where the question came in, and it's an important one, is kind of to ask that question, either because you left or you parted, the firm parted ways with the employee, because it often is not something that they just kind of remind you, right? Like that people need to kind of be aware of it. So I think that's the question came up. I think it's an important one. It's like that window of time and options. If you part ways or they part ways with you, you should ask questions around the window, because the window might not be 10 years. It might be 30 days.
Yeah.
Sorry to interrupt, but I figured that was a good question that came in that maybe a lot of other people had on the window.
No, that's a great point. I'm glad you brought that up. And that segues us great into kind of walking through an example, a success story, if you will, of why you should be excited about stock options. Even though they're confusing and can be overwhelming sometimes, it could be really successful. It doesn't always work out this way by any means, but this is what you hear, you read it in the news, you see companies, and it's fun and exciting, but how do they actually get to those numbers? So let's walk through the timeline. Let's say 2014. So 6 years ago, you joined a company, they gave you 5,000 stock options. When you started, the strike price or the value of that share is $2 a share. So this is a private company, you're working at a startup, $2 a share, it's exciting. So you know, if you want to buy stock at $2 a share, you can buy 5,000 shares, it's going to cost you $10,000. So that's the cost to own those shares. Now, 2019, 5 years later, let's say you're fully vested, you've got all of the vesting requirements met, and your company goes public. These are the big, exciting events. And the market will price whatever the company shares, they'll figure that out for you. You don't have to figure that out. They'll tell you what the price is. Let's say it's $50 when it IPO'd. So it goes public, it's now $50 a share. Now, you'll notice in this timeline, there's a 6-month difference here. Typically, with private companies that are going public, there's a window of time where you can't sell stock. Now, they just don't want you to manipulate the market in any way or have all the employees fail.
Specific information, right? Like that no one else knows type thing. Yeah.
Exactly. So they may put stipulations and the time frame differs. 6 months is pretty typical. So 6 months later, let's say, you now can sell stock if you want. So you look at the market, your company is now trading at $125 a share. This is exciting. So to figure out what that actually means for your wallet, you take the $125 a share, the fair market value, you subtract out the cost that you're gonna have to pay to exercise those options. And that difference, so 125 minus $2, that's $123. You have 5,000 shares you can buy and have a $123 profit on those shares. So the potential income is now $615,000. So when you started, you got granted shares that were, valued at about $10,000, but it was going to cost you $10,000. So there's really no value, it's zero. But with just 6 years, 5 years later, now you have maybe over $600,000 worth of income there. Now it's exciting, but don't get too excited because there's always taxes. That is always a sure thing. The government would like their take of your income. So things to think about here, you have that income number. You have already paid the $10,000 for the share. So that's an expense up front you've paid. Now you get to pay federal taxes. Again, tax similar to a bonus. So 22% there, you'll pay state taxes. So if you're in California, you're paying 10.23% in addition to your federal taxes. There also could be FICA taxes depending on other income sources. You may have additional Social Security, Medicare tax that you're paying on this. So just for this example, let's say you have $600,000, you're gonna net about $400,000. So there's gonna be a big chunk taken out for tax reasons up front before you actually get to keep that net payout.
And Christy, I think that for this one, it's also important to note that that 22% for federal, that's just what the government is going to withhold, but that doesn't necessarily mean that that's actually the marginal tax rate that you owe the government come April, right? The next year.
Great point. Exactly. So if you have $600,000 worth of income, your tax bracket's probably at the highest, 37%. And you've only withheld 22 because that's the standard. If your supplemental income is under that $1 million threshold, it auto withholds 22% for your payroll company. But you may owe that difference between your marginal tax bracket, say 37%, and your withholding 22%. That difference, you're gonna get to write a check for in April, most likely, and that's something that you really need to be sure to plan around. Figure out, do you have enough cash to actually pay that bill?
Yeah, we've seen this case a number of times here with technology companies and engineers and people that got to kind of, to your point, the exciting stage, and they're now got net pay, and then they realize that they use that net pay to go buy a house, for instance, and then in April now they don't have the liquidity to pay the difference on the taxes that they owe the government, right? So it's really important to get this right and to work with someone around making sure that you're withholding enough or saving enough, right? So that come April, you could actually pay it. We've seen this a number of times.
Yeah, you don't want that surprise tax bill. That's never a fun moment to have when you're doing your taxes or having your CPA tell you, okay, now write a big check to the IRS.
Yeah,
Nobody wants
where's
that.
the other $100,000?
Yeah,
Yep.
especially if you've spent it. So definitely want to do some planning around that. Which really, when you think about restricted stock options, all sorts of equity compensation, the tax consequence is really what surprises a lot of people. You really do need to be cautious of making smart tax decisions as you're deciding when's the right time to exercise these options. What do I do with the stock once I already have it? Thinking through these different scenarios, that's what's really helpful to get professionals involved. And it's not as expensive as you might think. So saying financial advisor or CPA, it's reasonably affordable because you have big income, you have big concerns and big considerations. So you need people on your team to give you that advice. Another thing is to realize what you're actually paying tax on. So it's not necessarily all of the income, it could be a portion of the income. There could be deferred taxes that you need to think through. And these get really specific depending on your situation, your company structure, what the timing of different things are. So to get that tailored advice, it's helpful to have someone just bounce ideas off of and make sure that you can pay that bill in April, like we were talking about, and cover the tax consequences when these stock options and restricted stock are vesting.
All right. So maybe we switch gears here to how much and when should I exercise? In essence, like we talked a little bit about the difference between the stock and restricted stock and options, but then the big question is, okay, now I know about options, but when and how should I exercise them?
This is the $1 million question. What do you do now that you're vested? You can take action, and it's hard to decide. And I'll tell you, there's not a one size fits all. It's going to be really specific on your company, your goals, your financial situation. And I think that's really overwhelming to a lot of people. I was reading a study and it said that there's $4.9 billion of cash left on the table for people that just don't exercise their stock, especially for private companies taking public, going through an IPO. It's so confusing. There's so many different media sources and information. You don't know how to make the right decision. And a lot of people just freeze and don't make any decision. And there's a ton of potential income that's just left on the table. So as you're thinking through, when should I exercise, or should I even exercise? There's a lot of different factors that are going to go into that. Figuring the cost. How much does it cost you to exercise these stock options? In our scenario, that's that $2 number, the strike price. But that's just part of the cost. The other part is that tax piece, which could be 90% of the cost if you're looking at different things that you're going to have to pay for. You also want to think about, is the company going public? If it is, then should I do it before the IPO or after? And there's case studies for both, to be honest. There's not really a right or wrong answer across the board. It's very specific on your situation.
And also at what price you receive the stock versus where the IPO is coming, and there's other kind of market considerations as well.
Absolutely, that's a great point. Think about, is there any money? Is there a point in exercising? Should you buy stock at $50 a share if it's only trading at 20? Absolutely not. That makes no sense.
Right.
So thinking through some of those different things, seeing your personal feelings on your company. Do you want to own that stock? Do you have confidence that the company is going to continue to succeed and grow? And then the timing. So the lockup period, figuring out, do you have enough capital to exercise, to buy those shares without having to sell them if there's not liquidity? So there's so many different questions that are probably all in your head. It gets overwhelming and it's hard to decide what you should do. Ask the questions. It's very important to be educated and be informed and have good sources to give you that really sound advice and good information so you can make the best decision for you. And that's really, the whole goal of these equity compensation pieces is they want it to work for you. Companies are not trying to confuse you. They're not out to get you. They really want to empower you, but it's very personal and it's a very specific decision. So ask the questions, figure out the right time for you, and then do it. Don't be scared. Don't leave money on the table if you don't have to. And if you have that potential, you have these awards, they're exciting. Take advantage of them. Absolutely. So let's say now you own them. So you figured out when the right time to exercise is for you based on your situation, your company situation. Now you have the stock. You own stock. What happens? So you need to decide when the right time to sell, when the right time to gift. What do you do with the actual shares that you have? And I would say rather than letting that stock, that equity compensation drive your financial circumstances, turn that around. Figure out what your goals are. Do you want to pay for college education for your kids? Are you trying to achieve a certain lifestyle or retire in a certain time frame? How can you utilize this as a tool to empower your goals to success? So think about it from your goals first, then figure out how to fund those goals and the right mechanisms and strategies to implement so that you can make sure to achieve them. And if that sounds intimidating and you don't know how to figure out what realistic goals are or who to help you figure out a strategy for that, that's what financial advisors are for. They want to help you. They have tons of ideas and they're an awesome resource to make sure you can actually achieve the goals that you want to achieve.
Yeah, and we'll talk a little bit about in a couple of minutes of how to make sure that the advisor that's giving you that advice knows this topic well enough to help you with those decisions.
Yeah, that's a great point. So as you're figuring out these goals and what you really want to do with your investments, with your stock, with your compensation, start with the financial planning side of it. Figure out what makes sense, what you're trying to accomplish. Let that drive the investment decisions that you make. Whether you sell, whether you don't sell, as you diversify what you invest in, that should all be stemming from the goals that you have for you personally. Based on those investment decisions, there's going to be tax consequences. You need to be sure you're prepared for those different taxes that are going to come in: capital gains, ordinary income, state taxes. Based on lots of different tax planning and the equity compensation, payout potential, income potential, there's estate planning things that go into that as well. Do you need to think about estate tax? Have you bumped up to a high enough threshold where that's going to come into play? Right now, that's pretty high at about 22 million if you're married, but there's proposals for that to go back down to 5 million. So that could encompass a lot more people into these estate planning conversations. But beyond that, figuring out, if I die and I have equity compensation, what happens?
Right.
Does my survivor get that? Do they not? How do they know what to do with that? So make sure you're having those conversations and figuring out the plan on the estate side of things as well, taking that into consideration. And then that brings it full circle to the risk management. So are you taking on unnecessary risk for payout potential that may not be as exciting as you think it could be? And factoring that in and just continuing that cycle of putting everything into perspective based on your financial plan. So I know that was a lot of information. Just to kind of summarize, make sure we touched on everything. High level summary, restricted stock units. These are typically less risky because there's fewer decisions you have to make. They're a little bit easier to understand. You don't have to decide when to exercise, when to buy. It happens for you. The only decision point that you get to make is when to sell the shares. So once you get those granted to you, you wait the vesting period, they come into your account, taxes withheld at the same rate it always is. Then that's when those decision points come in, is what do I do with the stock now? And that goes back to the whole financial planning process. On the stock option side,
Sorry, you had a couple more here?
Oh, a couple more, yeah.
Okay.
Just thinking through, what's it going to cost me to exercise, to buy these shares, even if it is at a discount? Am I prepared for that financially? Do I have enough cash flow to where it's not going to be way too expensive for me and I can actually cover the taxes? Tax considerations, again, are huge, and it helps to have that expert, but really keeping all those things in perspective of the full financial planning aspect and really tying everything together to make sure you're making the right decisions for you personally.
Okay, so in this section, the way that we thought we would approach it is, we mentioned that seeking advice could be the right route if you have a lot of questions and you want someone to help you figure it out. But how to find the right person is a process in itself, right? Not every financial advisor is going to be well versed on this topic. So what are some of the questions that that people could ask either their current advisor, or if they're in the market for hiring an advisor? What are kind of like the red flags or questions they should be asking to ensure that they feel kind of confident that they're picking the right person?
Yeah, there's a lot of different things that you can ask, and you should be asking these questions, especially if you're relying on someone to give you sound advice. So asking, do you work with clients that have equity compensation? If the answer is no, they may not have enough experience to be able to give you guidance on that. If
Yeah,
the
like
answer
almost
is yes,
before you tell them that that's what you're looking for, like help-wise, ask that question so that you get a better sense for sure.
yeah, exactly. And if they say, yes, I know about equity compensation, ask them what kind. See if it's the kind that you have. Do you just deal with restricted stock? Do you deal with stock options? What about incentive stock options? Get really specific, see if they've done it before. And if they have, okay, that's a good sign, past the initial vetting process. But then you can ask them, what companies do your clients work for that have received equity compensation? So every company is different on how they structure their plans. The key features will be the same, but if you work for one of the large technology companies, you can say, oh, do you have other employees here? That's not a confidentiality breach. They're not telling you the names of the employees. So you can say, oh, you know how my plan works. I feel confident working with you. They may not work with your specific company, especially if it's a private company. That's going to be a little trickier, but ask, have you dealt with private companies who have equity compensation? Ask those questions. There's sometimes misaligned priorities with advisors, and we see this every day at Zoe especially. But one thing that I would think about is, if you have stock options, your advisor should want to know when they vest, because that's exciting for you and for them. It's potential assets for them to manage and diversify, but they also need to ask you when they're expiring. If they don't want to know the expiration date because they're just assuming you're going to sell it and then give them the money to diversify, run for the hills. It's a red flag. They should want to know the entire picture of your equity compensation. And with that picture in mind, they should be asking you about your goals, what you want to do with it, how you feel about that stock, and not pressuring you to just sell it all or diversify. educating you on risks that you're maybe taking. But if you feel pressured to do something that you don't want to do, that's not the right advisor for you.
Yeah, I think this is key, right? And just to understand what we mean by misaligned incentives is that if advisors get paid via fee of the investable assets they manage, and let's say you have 99% of your assets or your equity in one stock, right? You could imagine that there is some incentive for that advisor potentially to say, "Whoa, why don't we move all that to the S&P 500, right?" So that they could actually manage more of it. So, of course, that doesn't necessarily mean that they might be wrong on diversifying, but the key is they should really be trying to get to know you and what is it that you want to do, and how, in essence, there might be an emotional attachment to that company that you worked your whole life and you want to continue to own part of it, right? So that you should make sure that your voice is heard, and if you feel like you're not, like you have to walk in eggshells, usually not someone you want to be working with, right? This is your life. This is all the hard work you put there. The last thing you want is for somebody else to kind of make those decisions for you. So I think that one's key, especially if people feel like this is a topic they're not as familiar with. They might kind of say, "I don't know, they know better." It's like, no, you could be well informed and then make your own decisions, right, with them and collaborate with them. But that is definitely a red flag if you feel kind of pressured to sell. Okay, so maybe I'll switch gears, Christy, for a second before we open it up to Q&A. Just to spend a minute or two here on how Zoe Financial can help you, right? For the people that are listening, but really for anyone that you think could be use of this service, right? So Zoe Financial, if you think about what we do, is think of it as a marketplace that on one side you have people just like you that are looking to solve for their particular pain point when it comes to their finances, and they might want to seek advice from a professional. We have a matching algorithm that matches you with a pre-curated, vetted financial advisor that could help you with that specific pain point, right? So in this particular case, when it comes to tech stock options, for instance, we're going to have specific advisors that deal with a number of clients that have similar situations and that got through a number of hoops, including an hour-and-a-half interview with Christy on the topic to ensure that they could actually provide the advice that we think is sound and in essence makes sense. So that's essentially what Zoe does from a practical standpoint. But as you can tell from this type of sessions that we do, the first step, no matter if you're hiring somebody else outside the network or you have an advisor, is to just make sure that you don't make, call it, unforced errors when it comes to those topics. Like, that's the reason I started the company. I worked at JP Morgan, I worked at Morgan Stanley, I worked at large companies, and I just saw so many, call it, unforced errors that changed the trajectory of people's financial life. So I left to start Zoe because I wanted to help, even if I could help a couple million eventually instead of all of the United States, like my job's done there. So even if you already have an advisor, hopefully this will help you kind of make better decisions. So that's on us. But Christy, turning it over to you maybe as to kind of why you, and I hear this from advisors all the time when they ask you on the phone, like, oh my God, you left Goldman Sachs to go to a startup. So I'll let you kind of take it away a little bit on kind of why you left Goldman to join Zoe.
Yeah, I actually get that question a lot as well. And
I've heard it a couple times before.
Yeah, it really just comes down to like my values and what I see value in. And I really do believe that sound financial advice should be accessible to everyone who wants it. And Zoe is creating that exceptional network of high quality advisors to help all types of people, not just the high net worth wealthy individuals. So I love what Zoe's doing. I love the direction it's headed in. I'm excited to be a part of the team and continue to empower consumers all over the country, not just a specific niche market, but to help more and more billionaires. Exactly. I want a bigger reach than that.
Yep. No, absolutely. Well, very cool. I think with that, let me see. Let's turn it over to Q&A. And I got a couple actually throughout the presentation. I'll try to, Christy, you tell me if some are too specific, I know that for some it's kind of like, well, I would need to know your situation. So just feel free to kind of punt and say, hey, let's follow up afterwards on the ones that you think are too specific. But we got a bunch already. So let me go through them. Okay, so this is kind of a broad one, which is, when is the right time to hire an advisor if I have equity comp?
It's a great question.
Yeah.
So it could be at any time, but some key points in time is either at the very beginning when you get it to help you evaluate, is it good? Is it what I should be doing? When you're getting close to that vesting period. So when you get some decisions that you're needing to make, that's another great point to say, hey, I've got some vestings happening within the next 12 months. What do I need to be aware of? What are some things to go through? Or if you're already past that and you've got stock options that are vested, anytime from that vesting period to that exercise period, that's another pivotal point to say, hey, let me get some help. Let me just ask some questions to somebody and get some advice.
Very cool. Another one is, and we talked a little bit about this, so, but if you have any other context, how do I know when to sell my options? That's kind of like it depends, right? In essence of your particular situation.
It is, and it's tricky because a lot of it goes back to, why do you want to sell? Is it to get cash, to get something that you want to buy? You have an expense that's coming up. Okay, then that could be a good reason. It's also your outlook on the company. Do I think it's going to continue to go up? Do I want to hold these shares and be really invested in this? Or do I want to take some of that concentration risk off the table possibly? There's so many different questions that I think about when is it the right time to sell? And it goes back to figuring out why you want, why are you thinking about selling? What's the trigger or the goal or the point that's bringing that up? Is it just that you're now able to? Okay, then what would you do if you did? And kind of play out those scenarios to say, okay, let's say I sell it today. Then what happens? Walk through that, see if it's the right time. Or if you don't really know yet, then ask questions, figure out what your coworkers are doing, what other people are doing. Ask your advisor, hey, when do you see people typically sell their stock options or sell the stock from their company, and why should I do it? See what other people think about that too. But it's a very good question. It's hard to say the exact right point.
Yeah, so I have a couple here. I see two different people that asked the same questions. Might as well, and I'll take this one. Is, how is Zoe compensated, right? In essence, for making that introduction. I think it's a really good question because we were very careful about aligning our incentives with both sides of the equation. So if someone hires, maybe I'll start with the other option. If someone interviews an advisor in the Zoe network and they don't hire that advisor, Zoe doesn't get paid anything from either side, from the consumer side or the advisor side. And essentially the way that we look at it is we're not looking to get paid for just lining up some consumers to talk to some advisors, right? Like there's no value in either side for that. So in order to align the incentives, the way that we set it up is we get a referral fee from the advisor in our network that you end up hiring, but that doesn't come out of your pocket. In fact, the industry is fairly regulated, so they can't price you higher for coming through Zoe, right? So let's say they're charging 1% fee for managing your assets, your $500,000 assets. They're not going to charge you 1.x more because you came through Zoe. It's actually, you can't do that, right? So we just essentially take a potential, a percentage of the fee that the advisor would charge you, but it's free to the consumer. And the reason the advisor would do that is that we're essentially qualifying potential clients for them. And they're kind of coming straight to them, and is usually a great match. So all of a sudden the advisor could save time of having to go and find you at a country club somewhere, right? You found them, you matched up through Zoe, and that way, in essence, both sides are happy with the equation. But it's a good question. We were very careful to ensure that essentially how we get paid is aligned with you being happy with finding the right advisor, and the advisor obviously being happy because they're growing their firm. So let me see if there's any other questions on the topic. Yeah, actually, this one is a really good one, which is when I'm evaluating a company, a startup, what are the things that I should be looking for when it comes to stock options, right? And as a founder of a startup, what I would say that people should be considering is what is the fair market value when you're joining, and essentially how much has the company raised? Because it's fun to say, hey, I joined a unicorn, right? Oh my God, I joined this amazing company that's valued now at $3 billion. But let's say that that company raised, 4 rounds, 3 rounds all in 1 year. And now when you're coming in, the valuation is, let's say, at $1 billion, and they have no revenue and there's only like 30 employees. That sounds great to like tell your friends, but now the issue is that the fair market value for the, say, stock options is really high. So in order for you to actually generate significant returns or income out of that, it has to go up a lot higher from where you came in. And on top of that, you might have to pay a fairly high price to own the stock, meaning like you'll have to pay a high strike price to actually buy the stock itself. So just be wary, or be aware that there's kind of two sides of the coin. It's great to join companies that are really well funded, of course, but just ask those type of questions. What's the fair market value? Where was it last year? How much have you guys raised? Those are all good questions to gauge a sense of, am I kind of ballpark at the right stage of the company that I wanted to join? And do I see a lot more upside? Or did I join kind of at a level of valuation that I don't necessarily see a significant upside? Because essentially that's why you want equity in the companies, because you believe that there's going to be more upside. So that's kind of my take, but I don't know if Christy, do you have other comments around that? Kind of from more from a...
No, that I think that covers it really well from the timing point of it. I think if you're evaluating a startup, there's more than just the equity piece to evaluate. Like from my standpoint, it's who are the people there? Do I believe in the people, the mission, the company, kind of those more touchy-feely sides than just the numbers, because that's what makes a company successful. It's the little things, it's the actual individuals in the startup that's going to make it succeed or not succeed. And so evaluating that, I think, is just as important as evaluating the financial side of it too.
Perfect. All right, let me see what else we're missing. A bunch of other questions that have come up. This one, so once you have the vested shares and you decide to sell, if it's been over 1 year, would you pay just the capital gains of 15%? That's the question. And again, feel free to punt if it's too specific or of a question.
Yeah. So if you already own the stock, so you've exercised it or they vested, you own the stock, as long as it's been over that year and you sell it, it's capital gains tax. So that's 0, 15, or 20% tax, depending on your other tax bracket.
Yeah.
If you sell it under that year, it's just ordinary income on that gain.
Perfect. Okay. And a number of other questions that ask, how could I find advisors that could help me? So I think this is a good way to segue here to tie it all together with how can you connect with an advisor, right? So one, you could call 646-680-9244. You want to do it old school? You could do it that way. You could go to zoefin.com and fill out a form that will help us identify, our algorithm identify who the right match is. Or you could just email us, concierge@zoefin.com, and just put in the comment field looking for a financial advisor. And we're happy to help you. This whole web conference has been recorded. So because you signed up via email, you'll get an email with all this information. But if you don't, feel free to email us at concierge@zoefin, and we'll send you the video clip. So with that, I want to thank one more time Alexandra, Camila, and the marketing team for putting this all together. And obviously, I will thank Christy for putting the time together, put this presentation. I think this is one of those topics that's probably the most esoteric yet important ones for a lot of people, especially in the tech space. So thanks so much, Christy, for your time and for your insights.
Absolutely. Happy to join. Glad we could chat about it some.
All right, guys, with that, we'll close it there. Have a great day, and thanks for joining.
Thank you.